Hey guys, Dave Keller here with Market Misbehavior. Hope you're all doing well. Today we're going to talk about the US dollar, what it means for intermarket relationships, particularly from a technical perspective, how we look at the US dollar strength or weakness relative to other currencies, and how that might make have some implications for other asset classes. In particular, we're going to talk about the dollar that has been weakening for quite a while, but really, if you look at 2020 versus 2021, it's been a very different environment. So what does a rising dollar mean? What other asset classes, what other markets tend to be affected? What is it telling us about prospects for different asset classes going forward? Today, we are talking about the US dollar. So the US dollar is the most widely used currency in the world. A lot of transactions, a vast majority of transactions involve something dollar denominated. And that's why there's so much of a focus inside the US and outside the US on the prospects for the US dollar. Now, we've had a situation where the dollar has been falling for about a year, starting at the March 2020 equity market low to the end of last year, the end of 2020. The dollar is in a pretty consistent decline, steady pattern of lower highs and lower lows. Now we're seeing a change of character where the dollar is starting to go higher. So what does that mean? Before we get to the charts, as a reminder, love to have you subscribe to the channel if you're up for it. It'd be great to have you along on this journey. Also, if you like what we're doing here, give us a like, put a comment below the video. Tell us what you think is the most important asset class to follow given the potential strength in the dollar. What do you think is most important to follow? Let's get to the charts. Okay, so here we're looking at the US dollar index, and on stock charts, it's $USD, but a lot of other charting platforms, you'll see it as $USD or sometimes DXY or something like that. There's also an ETF called UUP, which is a bullish dollar ETF. In the short term, if you're looking at like 1 day at a time, the relationship between those two is pretty similar. That's pretty much a wash. So you can look at the UUP for an intraday read on what's happening with the dollar index if you don't have access to a real-time dollar spot rate. However, if you look over longer periods of time, it is important to not use the UUP because of the way it's constructed. It's not 100% of a correlation to the US dollar the further you'll go back. So with currency ETFs, with commodity ETFs, you have a challenge of following it one-on-one. So UUP is fine for the short term. Over a long term, make sure you're looking at a dollar index. So either $USD or DXY, something like that. Now, the dollar currency rate, the dollar index, is actually an index of the US dollar versus other currencies, because most currencies, not all of them, are usually quoted relative to the US dollar, to the euro to the dollar, the Japanese yen to the dollar, the Aussie dollar to the US dollar. It's kind of the normal way things are quoted. You also have crosses, so things like the euro yen, Aussie dollar yen, something like that. But in general, things are looked at relative to the US dollar, and it's a zero-sum game. So you don't quote a currency's value as its own value. You do the currency value relative to another currency. Currencies can only strengthen or weaken relative to something else. So this chart we're looking at, $USD, is actually a basket of currencies and how the dollar is relative to those other currencies. So if the index is going down, it's underperforming. The dollar is weakening versus that basket. If the index is going higher, that means the dollar is strengthening versus those other assets. The currencies that match up, it's a lot the euro. And so if you look at the chart of the euro to the US dollar, it's sort of almost exactly like this, but inverted. It's the inverse of this because the euro is the biggest weight in this basket of currencies. So a lot of times you can look at the euro and just think of it as flipped over, and that's pretty much what you'll see from the dollar index. So what's happening? So if you think of the S&P chart in your head, the S&P bottomed out at the end of March. That's here, the peak in the US dollar index. From there, as stocks were strengthening, you see the US dollar has been weakening pretty consistently. That's from the end of March of last year all the way to the end of last year, really the beginning of January of 2021. Same thing, you can see the RSI in a bearish range as it is fluctuating between oversold and then not really getting much above 60 on any bounces higher. The bottom, we're looking at a ratio, which we'll get to in just a second. Look at how the character of this chart changed, though, from a downtrend in 2020 to an uptrend in 2021. You made a transition from lower highs and lower lows, a confirmed downtrend, to higher highs and higher lows, a confirmed uptrend. So Dow theory would tell you that we've gone from a bearish dollar to a bullish dollar. So things have definitely changed. It's worth noting just right now, if you watched some of my videos last week, we've talked recently about home builders We've talked about financial stocks in particular, and a lot of the banks right now have a bearish divergence, much like semiconductors did about a month ago. Bearish divergence and momentum divergence is where the price goes higher, but the momentum actually slopes downwards. The RSI slopes downwards. Here, you're actually seeing the inverse of that. So you're seeing the dollar index go lower in mid-December to early January, and you can see the RSI is actually sloping higher. This is called a bullish momentum divergence, which suggested that this downtrend was over. You had a very similar pattern, by the way, back in August of last year, which is why this rally seemed really impressive to me. While I was getting all excited thinking we would return up to this 97 to 98 range. We didn't, though. We sort of made a new swing high and then continued that downtrend to go into the lows in January. Once again, we have seen the dollar start to improve. Pattern of higher highs and higher lows. You can see the RSI is back in bullish range, fluctuating from overbought when the price goes higher, and on a pullback only getting back to around 40, not going much below 40, and that's more of a bull market range for the momentum indicator. So why is this so important? What does this mean? So the dollar strengthening or weakening has a lot of sort of ripple effects around the economy, a lot of different asset classes you can relate to, and what tends to happen. In general, stronger dollar usually lines up with increased interest rates. So higher rates in the U.S. would mean a stronger dollar more often than not. The U.S. dollar outperforming tends to be better for small cap stocks than large cap stocks. Just because of their business models, and small caps are usually more focused here in the United States. So a stronger dollar not affecting them as much. And so stronger dollar usually means small caps would outperform large caps in general. At the very bottom, we have the relative performance of U.S. stocks versus global stocks, the SPY, which is a U.S. ETF versus ACWI, All Country World Index, so sort of the entire global equity market. So stronger dollar would tend to be good for U.S. stocks relative to others. Here's the thing. So what has actually happened? Well, the dollar index has gone from a downtrend to an uptrend. A big reason for that arguably would be the rise in interest rates. And interest rates certainly have changed from a downtrend in rates, a strong bond market, to an increase in rates. Rates going higher. If you look at the 10-year yield, you've seen it's obviously been increasing. That's been helpful for a lot of different assets, particularly financial stocks that have done better. So the stronger dollar makes sense. And the reason is because investors will tend to flock to the U.S. Because of the higher interest rates that would actually push the dollar higher. So there's sort of that relationship. What has happened is certainly the U.S. stock market, U.S. equity markets have been outperforming global markets. Some people like to think about stronger dollar as being good for stocks. I don't think that's a great thing to think about, just because if you look at this chart, you can see how the dollar's been weakening over the last year, and in general, stocks have been pretty good across the board. And so it's really more about the ratio. It's more about how U.S. stocks are investors going to allocate more back to the U.S. or outside of the U.S. And a stronger dollar would suggest there's more of a potential upside of being in the U.S. And that's what this chart has shown you. So when I told you about all these different relationships, here's the challenge. Those are all generalizations. Can the dollar go up and U.S. stocks underperform global stocks? Absolutely. A stronger dollar tends to be bad for commodities, especially gold. But can the dollar and gold both go up? Of course they can. They can also both go down. Bob Prechter from Elliott Wave International has done a great job in presentations I've seen about relating, cautioning against relating two assets. Don't ever take one thing, the dollar, and one other thing, U.S. stocks, and think it is a one-to-one relationship and that they happen in a vacuum. The way that I tend to describe them are more as headwinds and tailwinds. A stronger dollar tends to be a tailwind for U.S. performance versus non-U.S. performance. Stronger dollar tends to be a headwind for gold prices. So stronger dollar usually suggests weaker gold. And we've certainly seen that year to date, with gold prices certainly being in a downtrend while the dollar has gone higher. Stronger U.S. dollar tends to line up pretty well, tends to be a tailwind for or a headwind for bonds, a tailwind for interest rates, as higher rates and the higher dollar tend to line up pretty well. Having said that, that is not a guarantee. And just because you think you have a perfect read on the dollar and you think it's going higher, that doesn't necessarily mean that any of those other things are going to happen. Those are just headwinds and tailwinds, sort of the general tide. The little waves, the ripples of what actually happens in the markets can be very, very different. And even looking at this chart over the last couple of years, you will find times when the U.S. dollar does well and U.S. stocks underperform. So it is not a guarantee by any means. However, I like to think from a macro perspective, I like to understand where the headwinds and tailwinds are.
Year to date, we have seen a stronger US dollar. So, as a reminder, what that tends to mean is more likely than not, US stocks are going to outperform non US stocks. We've certainly seen that. Gold is going to be weaker, which we've certainly seen. Interest rates are probably going up, which they definitely are. The question now is how much higher can the dollar go? And that is the real question. The US dollar index, dollar sign USD on stock charts, is back above its 200-day for the first time since May of last year. So it's had a long time in an established downtrend below the 200-day moving average. It's just finally reclaiming it in the last week. So that's a huge change, not just the downtrend to uptrend transition, and now being in an established uptrend, getting back above the 200-day moving average is pretty significant. So we're next. The first line, as I saw the potential break higher in the dollar, saw the higher low at the end of February, I was immediately drawn to the September high. When you do a Fibonacci retracements, Fibonacci analysis from the March high to the low at the beginning of January, you can see that the high in September lines up almost exactly to the 38.2% retracement level, which is right around 95, just below 95. So in the short term, that is a very reasonable expectation. The dollar gets to 95 and we see what happens there. It's worth noting the dollar is just overbought as of the time we're recording this toward the end of March. It was overbought just recently in March. We had to pull back about a week and a half before resuming the uptrend, making a new high, getting above the 200 days. That's certainly something to pay attention to. Now, remember, things can become overbought and stay overbought. That is absolutely right. But the overbought condition could suggest that we're getting near the end. The fact that we're lining up and getting very close to these previous highs, sort of in the 94 to 95 range, I think is pretty interesting. I think we're potentially getting to that point. What could be a potential scenario is the dollar index tops out in that 94 to 95 range. That could be where the pullback in gold and commodities maybe finally finds a floor and eager to resumption of the uptrend in the commodity space, which I think long term could certainly happen. Could mean rates have topped out for a while. They get a little bit further, but then they don't go much further than where they're at now. We start to see a dissipation of that environment, or at least a stabilization in rate stabilization in the sell-off in bonds. And the other thing would be, this outperformance of U.S. stocks could potentially be a short-term phenomenon. For me, however, I am absolutely focused on the fact that the dollar is in an uptrend until proven otherwise, until you get a lower high, a lower low, until you get a reversion back to a downtrend. I have to assume that the trend is in place, and the trend right now on the U.S. dollar is not down, it's up, suggesting it is strengthening versus other currency pairs out there. So that is the one chart for today, the US dollar index, dollar sign USD, focusing on price momentum and some of the intermarket implications.
All right, so that's our one chart for today, focusing on the dollar index, dollar sign USD, focusing on what it means in terms of headwinds and tailwinds for other asset classes. As I mentioned earlier, I'd love if you put a comment below the video. Let me know which of those asset classes, all those things, commodities, bonds, stocks, US versus non-US, which do you think is most important to pay attention to given the movement that we've had so far year to date? As a reminder, I'd love if you'd subscribe to my channel. If you like the content that we're putting out, it'd be great to have you along with this journey for all of our great content coming up. Also, give us a thumbs up, give us a like if you enjoyed the video today. From everyone here at Market Misbehavior, I'm Dave Keller. Be well, be safe. Talk to you again soon.